The US economy looks strong on paper. Jobs numbers are up, markets are stable, and yet millions of Americans say they're struggling more than ever. Grocery bills feel heavier, rent feels suffocating, savings are shrinking. So here's the real question. If the economy is doing well, why does everyday life feel harder? Tonight, we break down the quiet economic slowdown most headlines are missing. The strong economy narrative. For months, Americans have been told that the economy is doing well. Official reports point to steady job growth, a resilient labor market, and inflation that is no longer rising at the pace it once did. On the surface, these numbers suggest stability, even strength. But numbers don't live lives, people do. The disconnect between economic data and everyday experience has quietly become one of the biggest issues in the United States. While headlines talk about recovery, households talk about survival. One reason for this gap is how economic strength is measured. Government reports focus heavily on employment numbers, GDP growth, and market stability. These indicators are important, but they don't capture how far a paycheck actually goes. A job does not automatically mean financial security. Many of the new jobs created over the past 2 years are in lower wage sectors or part-time roles. Others come without long-term stability, benefits, or predictable hours. On paper, employment rises. In real life, financial pressure remains. Another factor is averages. Economic data relies on averages, but averages hide extremes. High earners can pull numbers upward while millions at the bottom feel no improvement at all. When economists say wages are rising, they often mean some wages are rising, not necessarily yours. There is also a time lag problem. Inflation surged quickly, but wage growth has been slow and uneven. Even when wages increase, they often trail behind the cost of living by months or years. By the time paychecks adjust, prices have already locked in higher levels. The stock market adds another layer of confusion. Market gains are frequently used as proof of economic health, but most Americans do not own significant stock investments. For families living paycheck to paycheck, market performance has little relevance to daily expenses. Housing further distorts the picture. Homeowners who locked in low mortgage rates years ago may feel financially stable, while renters face constant increases. The same economy produces very different outcomes depending on when and how someone entered it. In short, the strong economy narrative is built on indicators that do not reflect lived reality. It is technically accurate and emotionally disconnected. This gap is where frustration grows. When people are told things are improving but feel worse off, trust erodes. And that erosion matters far beyond economics. Inflation never really left. Inflation may have slowed, but it never reversed. That distinction is critical. When inflation falls from 9% to 3%, prices are still rising, just more slowly. The damage done during the high inflation period remains locked into everyday costs. Groceries that jumped in price rarely come back down. Rent increases don't reverse. Insurance premiums don't reset. This is what economists call sticky inflation. Food is one of the clearest examples. Essentials like meat, dairy, and packaged goods rose sharply and stayed there. Families adjusted by buying less, switching brands, or relying on credit. But adaptation does not equal relief. Energy costs show a similar pattern. Even when gas prices fluctuate, utilities often remain elevated. Electricity, heating, and fuel costs become fixed monthly burdens that squeeze household budgets quietly. Healthcare costs continue to rise regardless of inflation trends. Insurance premiums, co-pays, and prescription prices place ongoing pressure on families, especially older Americans and those without employer-sponsored coverage. The psychological impact of inflation is also underestimated. Once people feel prices are out of control, spending behavior changes. Consumers become cautious, delaying purchases and avoiding risks. That hesitation slows the economy further, creating a feedback loop. Credit has filled the gap. Americans have increasingly relied on credit cards to manage rising costs. While this keeps spending afloat temporarily, it creates long-term vulnerability. High interest rates mean balances grow faster, trapping households in revolving debt. Savings are another casualty. Many families depleted emergency savings during peak inflation. Without a financial cushion, even small economic shocks, a car repair or a medical bill, become crises. Inflation didn't just raise prices, it rewired financial behavior, and those changes are not easily undone. The hidden economic slowdown. Despite official optimism, signs of a slowdown are quietly emerging. Consumer spending is softening, retail sales are uneven, households are prioritizing necessities over discretionary purchases. This shift is subtle but significant. Businesses notice it first. Companies slow hiring, reduce expansion plans, and focus on cost control. Layoffs may not surge, but momentum fades. Credit conditions amplify the slowdown. Higher interest rates make borrowing more expensive for both consumers and businesses. Mortgages, auto loans, and small business financing all become harder to justify. Banks tighten standards, fewer loans get approved, economic friction increases. The labor market, while still strong on paper, shows signs of cooling. Job openings decline. Workers feel less confident switching jobs. Wage negotiations lose leverage. This kind of slowdown doesn't look dramatic. There is no collapse, no panic, just gradual pressure building across the system. And gradual pressure is often more dangerous because it's ignored.
Middle-class pressure points. The middle class is absorbing the most strain. Housing dominates the burden. Rent increases outpace wage growth in many regions. Home ownership remains out of reach due to high prices and elevated interest rates. Healthcare drains stability. Even insured families face rising out-of-pocket costs that disrupt budgets. Education costs add another layer. Student loan payments returning for millions have tightened finances further. Insurance premiums, auto, health, home, rise quietly year after year. These are not optional expenses. The middle class, once buffered against economic swings, now feels exposed. And exposure changes behavior. Why this matters going forward. Economic pressure shapes politics, culture, and trust. When people feel left behind, they disengage or radicalize. They question institutions. They demand change, even without clarity on solutions. This environment rewards simple narratives and bold promises. Whether the economy officially recovers or not, perception will drive outcomes. And right now, perception is fragile. The economy may not be collapsing, but it is quietly testing the limits of everyday resilience.